You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome to the show, Danielle, and Happy New Year.
Happy New Year to you, too.
Danielle, a lot of issues to talk about: the plunging price of oil, the U.S. dollar climbing, the Central Bank of Europe talking about more quantitative easing. But first of all, how about the U.S. Fed's promise to raise interest rates? You think the promise is going to be followed through?
Well, I think it's something they intensely wish to be able to do. I think Janet Yellen is absolutely legitimate in saying that it is her expectation or hope that they'll be able to start raising rates in April. I think that they desperately want to do that because they don't want to face the next recession with no, bullets in the gun whatsoever. In other words, already at emergency zero bound, when you're supposed to be able to cut rates. That's their whole raison d'etre, is that they want to moderate the business cycle by cutting rates when things begin to slow. So right now they're in no position to do that. And if the economy breaks down further, which is not their central forecast, by the way, but then they're always eternally optimistic on growth. If it gets worse than it is presently, which I think is quite likely with the downturn in the energy sector, they're going to be facing this, renewed slowdown with nothing they can do, complete impotence, except for maybe trying some more QE, but it would be seen as quite a desperate effort at that point, especially when it's already been tried ad nauseum everywhere else. So, yeah, I think they want to do that, but then as Charlie Evans, the Chicago Fed head, said today, said in a speech, he said, that if we try and raise rates early, that could be catastrophic for the economy. And then the stock market took off, roaring as if that has anything to do with anything right now. Like, the algos get that headline and it all shoots up. But I noticed things like the more sober commentators, like oil, commodities, flat and negative still on the news, not expecting that, there's going to be this great surge of new speculative money coming in if they don't raise rates. And then you've got bonds basically flat, and they've breached 2%. The U.S. 10-year Treasury in the past week, Jim, breached below 2%. So that's, again, this story that you and I have been talking about of deflation, of the weight of the debt and the older demographics in the world being the opposite of strong growth and demand. So I think that's why oil's been breaking down. I think it's just capitulating to the reality that there's just very weak demand. And, excess supply is certainly part of the story, but I think that the part that most people overlook is this weaker demand everywhere. So, they may indeed want to raise rates in April. They may indeed try and do it to save face, because their whole thesis has been that QE has worked and that QE has revived the economy, and now we can go back on our merry way of normalizing interest rates. But I think that if they do a rate hike, it'll be symbolic, and I don't think they'll do any more after that, because, as I say, the downturn in energy is a very disproportionately negative shock to the North American economy. It's been where most of the growth in jobs has come from in the capital spending and business over the past so-called recovery out of 2008, and now this plunge, it's a big shock to the sector. They weren't ready for, this big plunge in energy prices, and it's catching them off guard. They're over-levered. They don't have enough cash in the kitty, and it's quite a shock.
The European Central Bank is making noises about another big push to have quantitative easing. I'm hearing the date is the 22nd. Have you heard anything?
Yeah, well, this is the scuttlebutt. Of course, we don't know how much of this is just posturing out of the ECB again. We've got, I know for sure, one thing that makes me think that the Germans may indeed capitulate and try and come up with some kind of a bond buyback program is that they are holding the largest concentration of these weak country debts. So the Bundesbank and the Germans themselves are, holding a lot of their net savings in the periphery bonds that, are the subject of these quantitative easing proposals. And so, they don't want to have to write down or take a big hit to their own balance sheet. So it's just this really bizarre maze that the central banks of the world have got themselves into, by being too closely affiliated with the finance community, with doing all these toxic debt maneuvers and then buying it back. Now they're in this sort of a musical chairs nightmare where, they have to throw more good money after bad. They have to take more capital and buy back debts that shouldn't be at the values they're currently at in an effort to try and prop them up and make it look like things are okay a while longer. Meanwhile, you've got the implosion of the global economy going on in the background, and everybody's now doubling down on the U.S. as this great white hope again, that they can somehow decouple. But they've never decoupled from major downturns ever in history, and this time I don't think is going to be any different, especially when you look at, as I say, the bright lights have all been from Texas and the Bakken and, Alaska. It's all been the energy story that has driven the U.S. job growth and any strength we've seen in the economy for the last 6 years. So a big downturn there, and you've already seen it start, Jim. You've already seen some of these oil producers starting to announce layoffs. There's been a couple of filed for bankruptcy already. This was the quintessential period of great hubris and excess, this period, because capital was flowing freely, cheap money everywhere. People were giving, loans to these companies, many of them with very shaky management and track records and business models. They were giving them debt as if they were, AAA credits. They were loaning them money at, 3 and 4% interest, 5% interest for high yield debt. Historically, that's supposed to be double digit. You're supposed to get paid at least double what government bonds are paying to compensate for the increased debt default risk in that sector. And with the crazy mania that's gone on the past few years, people were just, throwing their cash at anything. And that's exactly what happened. So it's interesting now, that some people are starting to reflect on the math of, with the big plunge in oil, what's the income statement starting to look like at some of these companies, and it's becoming quite clear. Many of them have, there's an estimate that something like 40%, and that's typically conservative, of these companies could default on these bonds. So once you get that kind of a realization that you've given away money to people who are not that worthy of your credit, you see a big jump up in rates. So that's in fact what we've seen in that sector, energy sector debt. Many of these companies' bonds have crashed with their stocks, which means that the interest rates or the yield on these bonds has now gone up something like 10% in many cases, in just a matter of a couple of months, Jim. So, everyone's focused on whether the Fed can increase interest rates, but all they're talking about there is this overnight discount rate at the very, very front end of the yield curve. What's going on later on in the yield curve is this great dispersion between low quality credit and higher perceived quality credit. So the high income debt market is plunging. The bonds are plunging, which means the rates are spiking really high, which is actually price discovery at its finest because there is a lot of default risk there. That is correct that they should be repricing that paper. And yet you're seeing this flight to quality continue into things like North American government bonds and the U.S. dollar. So U.S. dollar is still surging today. So there certainly doesn't seem to be an expectation of, more QE coming out of the U.S. Fed at this point. At the very best, they may not hike rates in April, or they may hike rates by a slight amount in April. Really, that's all window dressing, because that's really lost its efficacy for quite some time now. When they used to come from 5.5% rates going into a downturn, they had some meat on that bone. When you're coming from 0.25%, it's all really just smoke and mirrors. And the real economy is going to have to go through a repricing phase here now that revenues are plunging in these very important sectors. So I think that, I'm encouraged. It's remarkable. There's tons of noise. Volatility's back. Canadian market up and down like a toilet seat in the last couple of weeks. But, net this week, Jim, even with these big, bold, triple-digit moves, Canadian market's still down a couple of percent as we speak today on Thursday for the week. And so the trend is simply down. Yield for the corporate debt sector, the yield trend is up, which is good because it was, as I say, mispriced. Commodity prices continue to erode further as inventories build. So all that, I think, the only thing that looks sort of off in a world on its own kind of, hallucinogen is really things like the large cap S&P, the REITs, which have supposedly responded of late with this idea that, there isn't going to be any rate hikes. So they take off in value, but they're already insanely valued. So just getting worse doesn't really help in any way. And the Canadian financials are still, they're off something like 7% from their peak, Jim. We expect them to come off significantly further from there as all this is priced in. I put an article on today on the blog. Deutsche Bank has done a piece on, things about to get really bad in Canada. And all of that, of course, stemming from the downturn in our oil patch.
Can you tell us more about the Deutsche Bank statement? Because I just noticed that headline in your blog.
Yeah, well, they were just, we've been talking about it for a while in our analysis, the mounting debt in Canada, that the concentration and reliance on the energy sector for the bulk of the new jobs that have come from the 2008 recession. That chart I show there from the School of Public Policy at the University of Calgary is the Canada unemployment rate. It shows it all the way back to the 1990s, but the point I'm making there is if you notice Canada without Alberta's oil boom, what the unemployment rate would be like since the 2008 recession, it's very modestly declined overall since in the so-called recovery. We really haven't had many net new jobs, except this chart particularly shows the Alberta oil boom that created jobs. Now, we have to remember how we got the big boom in the energy patch, and it was very much driven by the free money, QE, all that liquidity, incredibly low rates, and all the innovation that came in the commodities bubble before it. So lots of new technology that made new energy sources accessible by countries all over the world, not just Canada and the United States, Mexico, all over the place. We're able to access and produce, different kinds of energy. And now they've just got all that stuff on stream, and you can't turn that off like a tap overnight. It takes, many months to start closing down rigs, but as they do, jobs will start to fall again. It just goes without saying, that these companies, the large producers, turn on a dime. They're not in the business of burning through capital for long. They're very quick to cut their labor force when required. And I think this is going to be like a 1980-style downturn. This is going to be a secular shift down. It's going to persist for probably a period of years as the excess supply gets worked out, as people have to migrate to new areas to find work, Jim. This is going to be an employment mobility thing where people have to literally retrain and move back to other places to find work. We're starting to see Alberta trucks, even in Ontario. Each day I notice a couple of license plates, and we're still in the very early stages of this, right? It's only 6 months into the big downturn that's happened in energy. So I think that the trading range for West Texas crude, the long-term secular support, and we had charts put on the blog this week about that as well, it's just showing that, people have this idea that oil has to trade in the 60, 80, or triple-digit range, and that's a product of the credit bubble. That was a very anomalous period that came when the world was spending its brains out on subprime debt, when China was selling stuff to us that we couldn't afford, and when everyone was demanding inputs from raw goods to produce all this consumer stuff. That's no longer the case. And since QE in 2011, since liquidity programs, governments pumped in and companies produced and continued to stockpile and make as if the consumer was coming back any day now, that just doesn't happen. And so what you've got now is this capitulation of, oh my goodness, we've got so much stuff. We've got it piled to the rafters. We need to start liquidating some of this. And that's the phase that we're in right now. And it's not going to be a quick bounce in my view. I think it's going to take, as I say, it's going to be a deflation down in price, which could get us even into the, believe it or not, the $10 to $30 range was the long-term trading range for energy, for oil, for WTI, which Canadian West Texas crude is Canadian crude is about $16 below that quote. So it means currently, Canadian crude is something in the $36, $37 range. You could see that come off, a lot more. And I just don't think that Canadians or most people are prepared for that. And so especially given the debt levels. That means, as you know, when something interrupts income, when you get a sudden layoff, of course, that you're not expecting, you fall back on unemployment benefits, which is a tax which is a pressure on the government revenue stream. It's also, you fall back on savings. You look to equity in your home if you have to draw on to get you through the rough patch to find another job. Well, Canadians just don't have that meat there to draw on because they've foolishly spent and over-indebted themselves in the expansion phase this time.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. Danielle, with the Canadian dollar plunging as well, will that give any hope to Canadian manufacturing because our exports will be cheaper?
Oh, absolutely. In the long run, that helps with efficiencies for, the people that are selling goods into the United States particularly, but it certainly will help restore some competitive edge, which we have been sorely lacking with the strong loonie through this credit bubble phase. But again, it's a slow adjustment because, we have to have demand for our goods, pick up as well. And when you've got a slow, first of all, the entire global economy is in a slowdown, if not outright recession already. So then you've got, let's hope the U.S. continues to consume and decouple. As I said, that's the party line right now. But I think that with this downturn in energy impacting the U.S. as well, it may be that even the decline in the loonie isn't going to be sufficient to ignite, strong export demand from the United States at this point. So eventually it'll help. I think the Canadian dollar, in our work, the Canadian dollar, as I say, with the price of oil moving back into the 10 to 30 range potentially, you could see the Canadian dollar back in the, high 60s range, in the 70s range. And that would be more indicative or more in line with historical patterns. Before the world thought that Canada was the great white hope with all these great commodities to sell. Well, I'm afraid we're in the mean reversion period of that now. So, yeah, I think ultimately it'll help, but in the meantime, we have to figure out what else we're going to sell. The conservative government, notoriously ill-prepared for this, has been doubling down on energy. Maybe because Mr. Harper's from the West, I don't know, but maybe it's because it was the low-hanging fruit. It's the easiest go-to. I've said, we sell our rocks and trees, but really we need to evolve ourselves. We need to evolve our economy into a more, not just the raw goods, but more of the manufactured and innovative products that we can make and sell. So, I think we're in that phase though, Jim. I think, if you look at the demographics, you've got a lot of baby boomers that are a big weight, that are holding jobs and that sort of thing, but then you have a push for, of necessity, people to become more innovative, young people to figure out ways to employ themselves, to start new businesses, little businesses on the side. You're having people, that smart bulbs clip I put up is by Stack, which is actually one of the founders left Tesla to start these smart light bulbs. And these things use 80% less power than LEDs, Jim. Not your regular bulbs, but LEDs, which are already considered extremely, energy efficient. So I think that there's a whole bunch of smart things that we can look to in alternative energy, and we could be a leader in that, but we're going to have to get our head and our economy out from a sole dependence on just gas and oil and start looking at, because this push to be more efficient, to waste less, and get more, bang for your buck, I think is not going away. I think this will be a hallmark of a era where people are indebted and having to work with less. So they don't want to waste as much. When you are in a free credit, billowing bubble phase, everybody's wasting a lot, frankly. In the mean reversion where everybody's consolidating and trying to pay down and be more frugal, people focus more on what we can do to save money, to not waste resources. And I think that that gives an impetus for some pretty smart innovation. So I'm pretty optimistic about that. I think that there's lots of great things coming, in all sorts of different fields. But, it requires creative thinking, and we can't keep insisting on these old models, because I think that's just a path to nowhere.
Well, one way to encourage creative thinking is to get rid of the capital gains tax. You take a look at Britain, they lead the world in innovation, in new business ideas, and the government decided, why should we tax people if their small business is successful? Why not give them a break? Because they are, after all, small business is, after all, the biggest employer. Well,
maybe, but we already give a really amazing tax break to small business for anyone earning, revenues of $500,000, your income of $500,000 and less. You're paying something like 15% tax in Canada. It's very low. So I don't really think that tax on our business is the problem. I think that we need to have perhaps more level taxation field. I think that corporations in general have got off too light. I don't think they've been paying for enough of the stuff that needs to sort of drive the economy. I don't think that necessarily new taxes are the idea, because we don't want a bigger government at this point. We probably have to downsize the government. Again, this theme has to be doing less with more, and that means across everything. It means putting more accountability back into individuals, for all sorts of things, including their health. So I think that move may show up in a consolidation and downsizing in government. But I don't know that we necessarily need to give tax breaks to companies. I think that we probably have to maintain the same tax rate or increase it in some cases. There's too many loopholes where big companies are getting away with not paying enough of their fair share, in my view.
What direction can investments take right now to either be just safe or profitable?
Well, we had a pretty decent year in 2014. Our fixed income holdings made some nice gains, and our U.S. dollar made some nice gains. There's ways to make money. It's really about avoiding the things that are blowing up, which is really the focus. And I know that seems counterintuitive somehow to people. They think you're supposed to be always looking for the winners, but actually in this environment you have to be kind of sidestepping the losers as a primary focus. And I do think that we're coming to this really opportune moment, and it could be, within the next year and two, where we hit like a secular bottom in valuations. And that means you could be buying some of these, riskier assets, with, for example, high yield debt could be generating more than 10% a year again with not a lot of price risk. So you could be buying things like corporate bonds again, but not right now. Now they're in the mean reversion phase. You have to let the prices come down the way they should, and then they present great opportunities. Same thing goes on the equity side, the dividend side. Everyone's been panicked about how am I going to get income. Sometimes the smartest thing is to just pull back and say, income opportunities are going to come, but they're not at these price levels, because, even look at the financial sector. Like I say, the Canadian banks have been this, star turn. They've doubled in the last 2 years, like just crazy stuff. And people have piled in thinking they were getting away with something, calling them low risk, thinking that, they're conservative dividend paying, I'm making an income. Well, they've dropped more than 7% in a very short period of time. So there's, a couple of years of income evaporated quickly. And I think that the downside here is another probably 25 to 40% potentially, Jim, on these things. So, it's not the time when you want to be trying to reach to grab the dividend while you're losing big chunks of your capital. So you really just have to, let this thing play out a bit, let prices, come back to where they make sense on an investment thesis, and then you'll get some great opportunity.
Danielle, thanks a lot for chatting with us.
Thank you.
And best of the new year.
You too.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's the president of Venable Park Investments Council Incorporated. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward comments and questions to info@HowStreet.com. Also, don't forget about our YouTube channel, Talk Digital Network. I'm Jim Gotti.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.